watching Business Television India.
Hello and welcome to Business Television India. I'm Piyush Jain and you're watching The Market Guru. Joining us on the show today is Girish Pai of Nirmal Bang. Mr. Pai, welcome to the show. Now, there are so many things again we need to talk again, but let's first talk about the markets. What's the word of advice at present going to the clients for our viewers at present? The markets actually are giving us a sort of scare, I should say. I'm using the word scare primarily because the correction has been very steep. In a very short span of time, there has been a large correction. When you look at the global markets, right from RBI again, basically the measures from what we have seen again around the SEBI sort of measures coming, and now again global markets basically, we have been seeing some sort of cues again, which has been slightly adverse. But what actually one should be doing? Is it a sort of buy on dips market, or you should be staying on sidelines? What should be a general sort of perspective?
Yeah, I think one needs to understand that equities as an asset class is a very volatile asset class. The issue that has happened in the last issue that's been forgotten in the last 3-4 years has been that we've had a very low volatility situation in the markets because of a lot of liquidity kind of flowing into risk assets. Because of central bank action of the developed countries, plus in the domestic side, we've had a situation where any sell-off has been kind of bought into by the domestic mutual fund money. So post-demon, we've had a fairly large shift of money away from hard assets like real estate to financial assets, and that to equities. So I think that the low volatility situation is what's kind of creating this kind of sense of unease right now. Otherwise, if you look back in history, if you look at the 2003 to 2007 kind of time frame when we had a fairly long bull market, every year you had at least 2 or 3, 15 to 20% corrections in the equity market. So I think
that was very usual.
Yeah, it was usual because we didn't have the domestic wall of money, which we have right now, with about $1 billion of SIP money coming in, plus something more, which is coming in terms of lump sums which are coming into the Indian market. So I think that has kind of created this unease right now because we've seen this 3-4 year low volatility situation in the equity markets. But otherwise, this correction is par for the course. Yes, just below the index.
For a larger bull market.
Yes, it is. It is. I mean, if you look from a long-term perspective, I mean, we've seen multiple corrections in the last 15, 20 years for various reasons. It could be because India, one, didn't come back to power in 2004 when there was a very large correction. There have been corrections connected with China growth not coming through, various other issues. And when you look back in history, these are on the charts, they don't really look very meaningful. I mean, when you're in the correction at that point of time, you feel a little pain. But otherwise, if you look from a long-term perspective, it's not a big deal.
Two questions again. One question, even if you're thinking about, I was just looking at the numbers here, if you're growing at 7 to 7.5% as an economy, then we'll be becoming 2.5 times in the next 10 to 15 years, maybe 12 to 15 years. For equity market, 12 to 15% returns, perhaps the sort of more than doubling will require a much sort of shorter time here. But the question for an average investor out there would be that where are we right now? 10,400, 300, 100. Is it a good time to keep on buying in the smaller intervals? Is that something, a prudent idea, which you think is going to serve them well for the next 2, 3, 4, 5 years? Or you think we are bracing ourselves for 10%, 20% more correction? I know we can't call out the bottom, but I'm just trying to ascertain what's your own sense of risk management at present.
Okay, so if you're a retail investor, I would say the best way to invest in the market is to go through the SIP route. And these corrections are actually good for you because whatever money you put in is a fixed amount, and you get more mutual fund units for the money that you kind of. So these corrections are good. But if you are a direct investor, I would caution you a little bit because we think, at least I believe, that we're probably, if you look from a cricketing perspective, we are in a 5-day test match, and probably we are in the post-lunch session on the 5th day. From a bull cycle perspective, because this bull market in equities globally has been going on for about 10 years now, 9 to 10 years now. And somewhere down the road, we'll probably see a pretty sharpish correction, which could coincide.
Are you pointing out that pitch has a lot of cracks, and basically that's why we actually can see a sort of more correction?
Yeah, it could. I mean, my sense is it could. I mean, ball could swing a little bit more. You'll probably get a lot more bouncers coming your way because we have a situation where central banks are withdrawing liquidity from the market. We have rate tightening happening across various central banks. I mean, potential rate tightening that could happen. It started with the U.S. Fed. We could potentially see ECB starting that sometime next year. So, liquidity is tightening all over globally. And that could be bad for equities. So there could be a cyclical issue that equities are facing globally and even in India. So next 2 to 3 year time frame, I would think is a slightly more treacherous time frame for direct equity investors. So that you got to be a little careful. But Absolutely. If you have a longer term horizon, I would still think that you could buy into equities, but obviously you probably have to wait. You could probably see cuts on your portfolio, and you have to bear that and bear that pain for a period of time. But if you're an SIP investor, please continue to invest and probably put more into your SIP investments. That's the call I have.
Golden line again. If you're a direct equity investor, again, basically be cognizant of the global environment again, actually, in which we are at present. That was market again. Now let's talk about something again which you track very closely, and that actually is the IT sector. One earning, the mid-cap earning actually was being released, but now it's about the large caps. Another aspect about the IT stock, this has been about the currency depreciation. There has been a lot of sort of expectation where perhaps this large amount of currency depreciation is going to benefit for some companies in this quarter, some companies next quarter, some companies the quarter after that, because of the hedge book sort of sequencing here. So what's the expectation on the organic growth, the environment?
Yeah, so I think 2018 has been a good year relatively for the IT sector, more so for very specific large caps and quite a few of the mid caps. So growth is picked up. And when you step back and look at some of the other corporate indicators globally, if you look at S&P 500, capex growth, sales growth, if you look at stock 600, capex growth, sales growth, we see a pickup in 2018 or 2017, 2018, there's been a pickup. So that's kind of leading to the upside you're seeing in select large cap stocks. For TCS, for instance, growth is kind of picked up a bit. It's a very selective thing right now. I don't see that happening to some of the other companies. The mid-cap companies are showing better growth because they're smaller and, it's a rising tide lifting all boats in kind of a situation.
Any change to the trend on margins or revenue growth? I'm just trying to figure out if there is anything which is going to change because of this currency depreciation.
So, see, if you look at the margin impact for 1% rupee depreciation, it should typically be between 20 and 30 basis points. Okay. Now, I don't think all of that is going to flow to the bottom line.
Absolutely.
So there could be a 10-15 basis point kind of impact on which could be gained by these companies. Now, even that, maybe a couple of years down the road, even that will be probably given back to the customer in the form of lower rates. So that is the way I look at the industry. But
sure.
I think it's right now we are more tactically bullish on the sector. We are not like structural bulls on the sector.
Right.
Because of not just we think that growth is probably peaking. Our view is that FY20 may not be as great for TCS as what FY19 has been.
Okay.
And we think that so growth will probably come off a tad for TCS. We think the mid caps are pricing in a lot of the positives.
And when you're talking about revenue growth, or you're talking about
I'm talking about the revenue growth.
Okay.
Earnings growth is obviously subject to the rupee. So one of the things that what's probably changed between FY15 and FY15 and FY18, the earnings growth of some of the large companies was just in the single-digit territory. If you look at TCS, Infosys, and some of the others, 6-7% kind of earnings growth for 3-year CAGR. That has now shifted towards a 15 to 20% CAGR, which is a little better growth, a 7-8% kind of rupee depreciation. So the rupee depreciation has actually helped in pushing up the earnings growth picture by as much as like 10 percentage points. So that has helped. And obviously, the other issue is that institutions are seriously underweight even now.
Right.
Despite the very strong run we've seen in the CNX IT, they're still underweight, be it FIs, be it domestic funds, they're underweight by about 350 to 400 basis points vis-a-vis their benchmark. And obviously, the financials are facing the heat, be it from the interest rate. So it's a
switching option.
Absolutely. So it's a liquid sector. You can move there.
As I know, you have today again 4 stock ideas for us. So let's talk about them. Let's again talk about the first one again, and that's again the Dixon Technologies again. Let's talk about that stock again. Why do you like the stock again? one of its kind. It's a niche area again. You have very handful again. You can count on the fingers again. Handful of large electronic contract manufacturers. So, what do you like about the stock, and what's the potential you're looking for the stock?
So this is a company. It's the second largest player in the domestic EMS market. The first, the leader is Jabil Circuits. The story for Dixon is that it is playing into the consumer durable growth story in India. We think this is probably a multi-year or probably a couple of decade story, in the sense that we think that volume growth could be in the low teens for this industry for many, many years to come. And what we are also seeing is that the customers, the OEMs, are outsourcing a lot more. So they're focusing more on product design, in brand building, in building the distribution network, and not so much in terms of manufacturing. So we have these OEMs now who are kind of shifting their manufacturing to players like Dixon. And what I feel is that the company has placed itself in terms of its manufacturing capacity. So a few areas that's kind of a leader in. One is television sets, one is lighting. It's there in mobile manufacturing. It's there in washing machines. So
televisions.
I think what we're seeing there is a situation where the company is actually increasing its manufacturing capacity a great deal. So in televisions, for instance, what's happening there is that you have these Chinese manufacturers who are coming to the market, like Xiaomi, TCL, Skyworth, who are pricing their products at like almost 40-50% discount to that of LG and Samsung. And what that will result is in a situation where a lot of market share is going to shift to these Chinese manufacturers, and these Chinese manufacturers are actually giving their manufacturing to Dixon. So from something like 1.2 million televisions, which it had its capacity a few year back, it's probably going to have a 3.4 million capacity coming up. And we think that the kind of market share it had in television in terms of 50%, that's probably going to go to 80% over a period of time, because of the fact that we think that the LGs and Samsungs are actually going to lose market share to some of these Chinese players like Xiaomi. And
it's already happening in the mobile space, very evidently.
Yeah, so so basically it's a company where there are more and more customers coming in. Say in the lighting side, the largest customer was Philips. Philips is also out, selling some of these products in the overseas market. So
there's also potential of serving the Indian market, and then also
so the global market opportunity is a huge one right now. It's not really addressing it right now, but in the domestic market itself, I think there is on the lighting side, besides Philips, it's now looking at Wipro, looking at Crompton Consumer.
What about the competitive intensity? Do you foresee more contract manufacturers coming, or this company has something of a unique competitive advantage?
No, see, it's been in the market. It's been in this space for a fairly long period of time. And the thing is manufacturing capacity. So as I said, it's kind of ahead of the curve. It's kind of built the manufacturing capacity, and it's been able to deliver.
So that can take more brands.
It can take more brands. So I think and it's been executing fairly well. If some of these customers have been sticking around with this company for almost decades, then obviously it means that it's been able to deliver on the manufacturing side. So this is the other thing is like asset light model. It's a low working capital situation. Asset turnover ratio is almost like 16 times or something like that, is what I understand. So we think that earnings can compound at something like 25-30% over the next 3 years.
That's very good.
With very good return ratios, because asset intensity is low.
What's the target price you have?
So I forget. I think it's.
It's high,
3,250 or something like that. Okay, correct.
So it's almost again more than 20% again. In fact, almost 30% plus again what the returns actually.
Absolutely. So I think what's happened in the market is that we've had this big correction, and
but I have one small question here. You don't foresee the stock again towards hitting the life highs again in the near term? Is it?
No, so see, the market texture has to change. I mean, right now, what we had in the last 2-3 years was a situation where some of the high-growing stocks and good quality stocks were also being bid up. And as a sell-side brokerage, we've kind of raised our PE multiples every now and then to kind of match that. So now we have a reverse situation kind of building up. So unless the market,
natural, because index valuation multiples are coming down, so it's natural.
I think that is something that needs to be watched out. You may probably not see an immediate bounce back unless the market itself bounces back immediately.
But the long-term story,
the long-term story is pretty good. I mean, as I said, it's playing into the Indian consumer durable story and a lot of outsourcing that's happening out there.
Fair to say again. That looks good again as a story here. I have to move to the other stocks. Again, that's Westlife for us. Why do you like the stock, and what is sort of earnings growth you're looking for the stock?
Earnings growth is phenomenal. So after disappointing the market in terms of margins for many years, for the first time FY18 they delivered about 7% EBITDA margin, or it's slightly below that. So we are looking at something like a 12% SSG growth over the next 3 years, FY18 to FY21, driven by the fact that there's been a lot of menu innovation that's happened. So why we like Westlife is that it is addressing customers across the day. So it starts with breakfast and lunch and dinner and in between. So the menu has kind of expanded and it addresses all times of the day from a consumer consumption standpoint, and it is a value for money player. QSR is expanding for various reasons, and within that we think that it can deliver you SSG growth of 12%. We can 7-8% kind of store growth. So a 20-22% kind of revenue CAGR is what we're probably going to see from Westlife over the next 3-year time frame. And margins can expand a lot more. So from something like 6.7% EBITDA margin in FY18, we think that can go to 13.5 in FY21.
That's a huge jump you're expecting.
So we're talking of EBITDA, absolute EBITDA, quadrupling, almost quadrupling in a 3-year time frame.
Along with the margin expansion.
Sure. So if you talk from an earnings standpoint, we're talking about 100% CAGR between FY18 and FY21.
That's huge.
That's huge. But the stock is already factoring in quite a bit of that. So I'm not disputing that fact. Valuations are reasonably rich. But we think that that's a structural story. The company is still at 280, 290 store company. It can become a 1,500 store company over a period of time.
It will need a lot of fund infusion for that also, right?
So I don't think they're kind of growing at that rate that it requires any kind of great fund infusion.
So you believe that the cash flows are
7-8% store growth should not be so much of a problem for a company. And also the fact that EBITDA margins are improving from here on is actually going to be better from an internal accrual standpoint. So it's a good structural play. So Dixon is a structural play. Westlife is a structural play.
What's the target price you have having?
We have 485 so it's a fair bit of upside from where we are right now.
I want to ask this tactical question. Is Westlife a better sort of a pick than Future Consumer or any other retail stock or DMart? There could be difference between the stocks, between the categories, diversification. But is it something you like the most?
So if you were to compare that, this with say Jubilant Foodworks, which is your Domino's, I think that's the
absolutely that is actually much more direct comparison.
Absolutely. Yeah. So I think what we find about Westlife is that it addresses, the point I made was that it addresses consumers across the time frames. So you start with breakfast and goes down till late in the night for dinner. Also you can go, and now they have introduced the rice-related food option in one sense. So unlike Jubilant, where it's only during meal times you really call for a pizza, typically. You don't call during other times. So that is the thing that we like about Westlife, and also the price point. It addresses a much larger consumer base compared to a Jubilant Foodworks. Though Jubilant has also done a whole lot of good things in the last
So which means at present the burgers actually are sounding much more cheaper than the pizzas?
Because they've moved away from a burger. They've moved into a whole lot of other things other than just a burger. So the chatpata naan, and you have the rice-related stuff, and so there are a lot of other things so there's been a lot of menu innovation they've kind of brought about, which addressing the Indian consumer, which has been pretty good in one sense. So that's driving the SSG growth.
Another structural story of what
it's another structural story, absolutely. We like Jubilant Foodworks, by the way. It's not that we
still qualifies another buy category.
It would. So between the two, we would probably pick a Westlife right now.
On a valuation front or on a earnings growth?
On a structural growth front.
Much more stronger.
We would think so.
Okay, so that's Westlife for you. Again, another stock again from the QSR space. Again, earlier we talked about Dixon. Again, that was from the manufacturing space. Let's talk about the third one, Eicher again. Large cap, popularly known again, a brand basically which has served well again over the last many quarters. The stock has corrected actually a bit again over the last almost few weeks again. After this correction, do you think the correction is overdone? Because across the two-wheelers, and I'm looking from the last 12-month perspective, two-wheelers are underperforming. So is it only Eicher where you think there is real value and that's why you're liking the stock, or there is some other reason for that?
So I think what's happened is that the growth has kind of come off. I think investors are kind of resetting their expectations in terms of growth for Eicher. So from very fast growing company, it's probably down to the mid-teens kind of growth right now. So we think that Eicher in the large cap category, if you look at Hero, Bajaj, Maruti and some of the others, we think that this company can potentially deliver you 13-14% volume growth over the next 3 to 5 year time frame. Okay. That we think is probably the best kind of volume growth you will see across the auto industry in India.
Oh, there's the top of the pack.
Yeah, top of the pack from a volume growth perspective. Okay. I'm not talking about valuation here, we're talking about volume growth here. What we like is that we still think that there's a lot of room for market share expansion within the two-wheeler space. So if you look at, say, a state like Kerala or a Punjab or a Goa, which is a relatively more prosperous state, 1 in 3 bikes is a Eicher sold. Okay. In a metro, for instance, 1 out of, maybe a little less than that, 1 out of 5 bikes sold is an Eicher.
Oh, that's an indication of affluence. As more affluence increases, there's more
Absolutely.
demand.
But if you go to UP, Bihar and some of the northern Indian states, which are slightly lesser in terms of per capita incomes, that share falls down to like 4-5%.
Right.
So we believe that this is a structural story. There is already a existing bike base of maybe like 80-90 million bikes. They would all be aspiring to move upwards.
So in effect, you're saying this is a middle class expansion story. More income, more middle class. So there's going to be incremental demand.
Absolutely. So that is one aspect. The other is distribution. So right now, this company is largely a metro or a city-based kind of a player. It just has 950 odd retail points right now. If you look at Hero Honda, that's closer to 6,500, 7,000 retail points. So I'm talking about potential growth on the distribution side. The other aspect is it's hardly advertising. So if you look at a Hero or some of the other two-wheelers, they probably advertise to the tune of 3 to 4% of their sales. So Eicher hardly spends. It's less than 1% of sales is spent on advertising. So these are two: distribution growth, the fact that you have very low advertising.
Does Eicher have better return on equity compared to Bajaj or Hero Moto?
Absolutely. So I think margins are better. Margins are, no, I wouldn't say the return on equity is substantially better than Hero Honda. Sorry, Hero Honda is out Hero now. Moto. Hero Moto Corp, because obviously the dividend payouts are much larger for Hero, and therefore the return ratios are very good for Hero. But otherwise, if you look from margin perspective, there's a 30, 31, 32% kind of EBITDA margin. It's been delivering good return ratios of, I think upwards of 30, 35% is what I'm seeing for this company. So
your target is 36,000.
Yeah, it's a very high target. Right now, we probably have to kind of pair that in the kind of market circumstance we are in right now.
Still, you believe 50% returns could be coming for the
stock?
So
it should deliver you good returns and probably outperform the two-wheeler pack. Within the auto pack, probably this will be our best bet. Again, it's a structural story. It's not a cyclical story. We also like
coming from metals or any of the sort of recent news.
So there could be some RM pressure, but there also what's happening is they're also premiumizing. So there are some new variants which are coming out, which are being priced at slightly higher price points than what they typically have been. Typical bike is a 1,50,000 kind of bike. So you have 10, 15, 20,000 kind of extra premium you're getting from selling the newer variants of the bike. So that kind of takes care of some of the RM increases, that raw material increases that we're seeing right now.
Okay, so that, and last question before we wrap up the show again, that would be versus a Bajaj or Hero over the next 2 year period, what should be the average earnings growth?
Okay, that should be, I think what's happening is that Bajaj is probably benefiting from the overseas market kind of picking up, and rupee depreciation should be beneficial to it. I would probably think that these three companies should be delivering 15-20% kind of earnings growth. I'm looking at Eicher from a longer term standpoint. Right. It's more from a structural perspective. I think there's a lot more.
Like we're talking about Dixon and
absolutely. So I think there's a lot more room to cover from a market share standpoint for a player like Eicher versus a Hero, which is probably at a 50% market share. Though I think Hero is also coming out with some variants on the higher end bike side.
So all three structural stories, we'll leave it there. Perhaps we could have continued discussion more, but due to lack of time, as we're moving towards the end of the show, thanks a lot, Mr. Pai, for sharing all the insights. That was all we had on this edition of Market Guru. Thank you so much for watching us, but stay tuned as more updates will continue on the other side.